Imagine a financial earthquake so massive, it's not just shaking Wall Street, it's literally rewriting the rules of global wealth. Right now, a crack is spreading through the very foundation of the world economy. And the crazy part? It's happening in a place most people assume is completely untouchable.
So why is the absolute bedrock of global finance cracking right before our very eyes? For half a century, there was an ironclad law of money. When U.S. Treasury yields shot up, the dollar flexed its muscles and surged right alongside them. But today, that law is shattering. Yields are skyrocketing, yet the dollar is plunging. And I promise you, the real explanation for why this is happening is going to completely flip how you look at your own money.
Welcome back to Dollar Chronicles. If you want to understand the hidden forces driving your wealth, make sure to like this explainer and subscribe to Dollar Chronicles right now. Okay, let's dive into this. Just wrap your head around this massive number, $29 trillion. That's the staggering scale of U.S. Treasury debt outstanding in 2025. It's an absolute ocean of borrowing, and it's fundamentally warping the entire global system.
You see, historically, when we saw yields rise, it was a solid signal of a roaring, robust economy attracting foreign capital. But in 2025, yields are surging while the dollar is dropping. This 50-year rule has completely broken. Actually, scratch that. It hasn't just broken, it's reversed. Instead of signaling economic strength, this spike in yields is screaming something entirely different, something genuinely terrifying: extreme fiscal stress.
Part 1. The illusion of safety.
To truly grasp the magnitude of this crisis, we've got to look back at what made American debt so invincible in the first place. For decades, investors treated U.S. Treasuries as the ultimate untouchable safe haven. They had what economists call exorbitant privilege. Because they were universally accepted and deeply liquid, global investors gladly accepted a lower interest rate. It's a phenomenon known as a convenience yield, basically paying a premium just for the absolute security of holding American debt. You know, when the world got scared, money just flooded into U.S. bonds, no matter how little they paid. That safety guarantee was the bedrock of global portfolios. But what happens when that illusion of safety is completely shattered?
Part 2. The decoupling.
Okay, here's the shocking mid-explainer twist that changes everything you thought you knew about global finance. The bond market is fundamentally breaking and decoupling from the dollar. Let's look at how this built up across a timeline of what we call the debt flood. Back in 2008, outstanding treasuries sat at a manageable $5 trillion. The market could easily absorb that. But then came the flood. By 2015, a valuation gap started to widen between the dollar and bonds as debt levels crept higher. Then, the 2020 pandemic triggered an unprecedented, historic borrowing surge. Fast forward to 2025, and we're drowning in $29 trillion of debt. The U.S. government flooded the global market with so many bonds, it completely destroyed their specialness and their rarity. They're no longer a scarce, prized asset.
And boom, this is the exact moment the math changed. The safety premium? It has entirely vanished. That extra value, that convenience yield investors used to happily pay for the security of U.S. debt is just gone. Long-term U.S. government bonds are now actually forced to offer higher yields just to convince people to buy them compared to comparable foreign bonds. So the crucial point we have to ask is this: what could possibly happen to the global economy when the world loses its ultimate safety net?
Part 3. The escalation. The fiscal nightmare.
Well, the answer to what happens next lies in newly released, honestly, terrifying projections from the world's top financial watchdogs. Listen to this staggering number: 120%. The Congressional Budget Office projects that U.S. debt held by the public will reach 120% of GDP by 2036. I mean, that completely crushes the post-World War II record of 106%. We're literally borrowing at a wartime pace, but there's no war. Only unchecked spending.
And the institutional watchdogs are stepping in. In May 2025, Moody's delivered a massive structural blow, officially downgrading the U.S. sovereign rating from AAA to AA1. They impartially pointed to a federal deficit projected to widen to 9% of GDP by 2035. Unchecked government spending is rapidly deepening investor concerns over American creditworthiness.
Which leads us directly to a highly dangerous, menacing economic dynamic known as fiscal dominance. This is a terrifying scenario where massive government debt forces an independent central bank to completely lose control over fighting inflation. The Federal Reserve basically becomes trapped. Think about the math here. If they raise rates to fight inflation, they bankrupt the government because the interest payments on that $29 trillion absolutely explode, eating up the entire federal budget. But if they cut rates to save the government's balance sheet, they let inflation run wild and send the cost of living to the moon. They are totally trapped. And this trap, It's about to have a devastating impact on your everyday life, draining your purchasing power while wages struggle to keep up.
Part 4, the climax. Real-world impact.
Because you see, this isn't just theory happening in the halls of Washington or Wall Street. This macroeconomic crisis is crashing straight into the real economy. The ticking time bomb is right here, $5.1 trillion. That's the exact amount of U.S. debt set to mature and be refinanced before July 2025. And it has to be refinanced at today's dangerously elevated interest rates. This means the government will be forced to spend hundreds of billions more just to service its own debt, effectively starving the rest of the economy of capital.
And the private sector is already buckling under the pressure in what we can only call a corporate credit collapse. In April 2025, low-rated corporate borrowing plunged to less than $1 billion, the lowest in years. Credit availability is shrinking fast, which means slower wage growth, hiring freezes, and a rapidly rising risk of severe economic contraction. Looking back at the debt flood, would a different decision have changed history if policymakers acted differently years ago? Tell us your opinion in the comments.
Part 5, the Wealth Escape Plan.
But while average citizens are left to deal with the fallout, the smartest money in the world is already executing a wealth escape plan. The sheer scale of the danger to everyday people is absolutely staggering. Right now, a dangerous imbalance exists. 65% of passive portfolio assets are concentrated entirely in U.S. equities. For years, investors relied on a strategy where bonds protect them when stocks fall. But because the bond market is decoupling and the safety premium is completely gone, this proves that the classic 60-40 portfolio you've been taught to trust is fundamentally broken. It's sitting right in the crosshairs of this crisis, heavily overexposed to a system that is showing massive cracks.
And here's what the institutions are doing about it. We're seeing a historic pivot from the old safe haven of U.S. Treasuries straight into the new lifeboats. Global investors and massive central banks are diversifying heavily into emerging market debt and gold. Gold isn't just an ancient relic anymore. Right now, it's serving as a critical, standout shield against skyrocketing inflation and the terrifying reality of U.S. fiscal dominance.
So, do you think the world will look different today as the dollar's traditional shield loses its crown? We are living through a once-in-a-lifetime shift in how global wealth is protected and distributed. To make sure you never caught off guard, hit that like button and subscribe to Dollar Chronicles right now. If you thought this story was incredible, wait until you see the next one. Click the next video on your screen now.